Welcome back to day 13. Today we're going to look at how we actually analyse deals. This is a very important part of the process, obviously. You want to make sure you're getting your numbers right and your due diligence right, because you get it wrong and it can be the end of your property career there and then. I have witnessed some horrific purchases, some horrific rental deals, and they are costing people money, and I've seen the downsides of that. It's not pretty. But ultimately, I have also seen the successes, and by doing good due diligence, making some good profit and having properties that cash flow well every single month, which obviously is the ultimate goal. So I have my own way of doing it, and I'm going to show you how I do it. I also have my own tool, and again, I'm going to show you that tool as well. And I do think it's vitally important that you become a numbers person when it comes to analysing deals. You don't have to be, Einstein or Stephen Hawking. You just need to know what numbers are important, how to calculate them, and to make sure that you're getting them right, so you know that you're buying into a good deal and not buying a dud. So what I'm going to do is I'm going to run through sort of buy, refurbish, refinance first, and then I'm going to run through how we sort of analyse serviced accommodation deals, HMOs, single lets, lease options, and look at how we sort of compare as well. So all in all, it's just about, as it says here, calculating profitable deals before you actually invest any time or money into the process. So for me, I use this is my sort of deal calculator here, and it's served absolute wonders for me over the years. And I've built this, more and more. You see here it's got BRR analysis, SA analysis, HMO analysis, and then obviously the comparables, which I'll come to. So I'll run through how I would sort of analyze a deal on this, so you can kind of get a feel for the numbers and how it all works. Obviously, you can see here is all the information that we talked about a couple of videos ago. Make sure you collect the contacts, the emails, the lead source, etc., what the property address was, what it's advertised for, when it was first listed, that sort of stuff. And that's important data, because as you go along here and you keep putting more and more properties in, this is where you go back to every 2 weeks, and you go back and you say, right, I'm going to contact that agent, that's their number, and you give them a ring. Is it still available? Number, whatever, postcode, and it's time efficient, and it works well. So what we do is, we assume we've got a buy, refurbish, refinance deal on the go. Now, let's assume, it was advertised at, let's just say 70,000. We put that in there, and we're going to offer 50,000. So put that in there, and then you'd have your outcome here. So, pending offer, might get rejected, or ultimately accepted, which is what we want. Obviously, you might also go out to it and it might not be the right property, so you just tick that, but pending. So we're going to say that we want to buy that property for 50,000, and then what we then do is we kind of go through. So the grey areas of this are what I need to fill in, and then as you'll see as we go through, the numbers start to populate themselves. So legal fees, grand, and then obviously you might have your refurb costs. Obviously, I then also put notes, so I would click here and I would put a comment in, and I would write exactly what my notes were. Now, the reason you do that is, if you're going to do this properly and you're going to get on a number of deals and you're going to be doing so many viewings, then you need to be able to, you'll lose track. And I remember the days of doing sort of 10 viewings on a Saturday, and by the time I'd got to about the 50th viewing, I couldn't even remember what the first house looked like, and if it wasn't for photographs, if it wasn't for videos, then I'd have been stumped and it would have been a waste of time. So make sure that you're noting everything down onto your refurb costs. Quick tip on that: I used to put all my viewings in my Google Calendar on my phone, and then when I was on the viewing, I used to open up the Google Calendar and I used to open up and edit the notes, and then in the notes I used to just type away as I was going around, taking photographs, typing away all the refurb costs, all the points, and then what I would do is I would cost it up when I got back, or when I got back in the car. I kind of got in the habit of doing that, because again, if you're going on multiple viewings, it's quite easy to forget, so it's easy to just quickly cost it all up whilst you're in the car. And then I used to just open Google Calendar and drag all the comments straight into this box here, and then cost it up and put the figure in there. And if you are paying any deal sources, I actually factor that into the purchase price. There are some companies that maybe factor it in as a marketing cost, but for me, it's part of the deal. And if that's why sometimes I always say that the deals don't actually stack up, because of the source and fees. mortgage broker fee, depending on what you pay your mortgage broker, and ultimately if it needs an HMO license, if you're going to run it as HMO, again, that's a cost into the deal. So then we have here, so if we're going to fund it through a mortgage, 25%, you'd be putting 12.5 grand down on a 50 grand balance, your mortgage arrangement fee and your mortgage interest rate. Now, what I then do for the monthly rent, I tend to jump over to Open Rent Calculator and just get a quick guide, of what the rent might be. So you just any, whatever, 1, 2 SD. Let's just assume it's a terraced house. It's got 3 bedrooms, 1 bathroom, calculate price. Oh. It's just 3 bedrooms, calculate price. So 710 a month, estimate range. And then, what I would also do is maybe have a quick look on Zoopla and obviously on the comparables on the rentals on Rightmove as well to sort of get my price. Now, this is a 50 grand property, so I'm not going to go, I'll probably say 495. I don't use letting agents. Obviously, I run everything through my office, so I don't have that as a fee per se to the property. Obviously, I have, people that pay, but they kind of do multiple tasks for me, so it's not directly just for this property. Some people may use letting agents of 10%, so you might want to put that fee in there. Insurance depends on what type of property it is and how many you've got, and then ultimately that gives you a net profit of that deal. Now, the new market value, I've shown you how to kind of find out over the last few videos, where you kind of go to the house prices and look at comparables for certain things in the same street. So let's just assume that once it's done up, the property's going to be worth 70,000. Again, mortgage broker fee 145, and if there's any exit penalties to pay on your mortgage, so if you're going to redeem this mortgage early, there will be exit penalties to work. I'm not a fan of doing mortgage to mortgage BRRs because A, they're slow, and B, you shouldn't technically be using the mortgage as a short-term product, but I know some people do it and some people start that way, and so that is why I've kind of built this way, because this was how I originally started before I actually got the experience and the trust and the confidence to use bridging loans. So exit penalties could be north of two grand depending on when you redeem. Obviously, you want to try and redeem as quick as you possibly can. If you decided you just wanted to flip the property, then you'd put in whatever your home report fee might be, your legal fees to sell, and and then it factors in 6 months mortgage payments, total investment costs, total selling costs, return from the deal in terms of profit is 8286, return on your investment 13%. So it does flip. Again, I've mentioned before, I don't actually flip property. I like to keep it. I kind of flip it on myself by refinancing it, and then I keep it for the cash flow and obviously the long-term investment growth. So this is kind of the main section that really jumps out at me. And you see the figures are all prepared for me here. I'm not having to redo this all the time. I'm not having to go through the ins and outs of it on a bit of paper and find a bit of paper 6 months down the line when someone texts me to say, will you buy my house now? So exit option is a buy to let with no refinance. So if we weren't to refinance this, we're just going to leave it on that mortgage product. We've invested 21 grand. Our cash flow is £374 a month. So it's going to take us 57 months, effectively, nearly 5 years before we see any, that full amount of money back out. Now, you can do a lot in 5 years with 20 grand done properly on a BRR strategy. So obviously we wouldn't want to tie that money up for that period of time. So we go exit option as a buy to let refinance. This is always my chosen route. So we've invested 24,963. We refinance monthly cash flows 315. Now this is more expensive than this because obviously we incur more fees by doing it this way. But ultimately it's worth paying the fees to get the money back out and recycle it. Obviously we're going to take a higher mortgage balance when we refinance. So up here you'll see that we mortgage 37.5 grand, whereas when we go for the refinance, we're going to be mortgaging 52.5. So naturally, the monthly payment's going to go up. So that's why that refinance monthly cash flow drops down. Now you'll see it's in green there. Now I think I've got this set for over 200, maybe £300 a month as my minimum cash flow in terms of a deal. So ideally, I want to see either a green and white column or 2 green columns here, and that means it's a green light to go. This column here is how many months it takes before the money's recycle back out. For me, that's no longer than 36. So cash out refinancing, I would get pretty much half my money back out by refinancing this. Stress test monthly payments. So what lenders look for is a 5 times multiple, or 5.5% multiple of the annual rental income to make sure that the rent's that's basically a stress test. So if that stress test was, say, £700 a month and we were only fetching 495 as a rental, then you wouldn't get a mortgage on it, basically. So you want to be making sure that you're covering that angle. The last thing you want to do is buy a deal, think you're going to do a refinance on it, and then you can't because the stress test doesn't work. I've not really come across too many deals like that, if I'm totally honest, but it's worth noting that figure. How much money we leave in the deal? 8 grand, probably a bit more than I would like to leave in most deals, but it's not the worst deal in the world. You've got your months before money left in, your equity created from day one, and your return on your investment. So that's kind of how I crunch the numbers through of every single deal. And as you can see, if I wasn't obviously talking you through this, it would have happened in about 45 seconds, maybe a couple of minutes if I had to do a bit of research on prices and stuff. We then have, your EPC register, so you put in whatever it was. Be mindful that you can't rent properties, that are in an F or below. So, you would have to do some upgrades on making them more efficient in terms of heating, if it was. So again, a cost to consider, which is why I like to note that there. And then what I do is I use these websites here to get these figures. So, we might go, so I look at the current average on the postcode and the last 10 years value change on Zoopla, more just to see how it's more than likely going to perform over the next 10 years. And then Zoopla valuation, let's just assume that came out at 65,000. Zoopla rental guide, let's just say, again, that was 500. Net house prices valuation, let's say that came out at 73 grand. Open rent guide was 710 on that one, but let's just assume it came out at 475 for this specific property at 50 grand. Mouse price valuation, I like mouse price. I do think it hits the mark most of the time. It throws the odd one up every now and then, but again, it does that and the rentals. Instant compare, another good site. So let's just assume we've got that there. And Rightmove comparable sales. So this is where you jump into your Rightmove, you go to sold house prices, and you sort of get your good feeling, and you put that in there at what you think that property's worth. And ultimately, you can see that then gives you an average valuation. So in this case, it's 70 grand. What we then do is land registry. You can put when it was last sold if you want, and then if you want to put any notes about the property, you bang them in there. The more information you put into this, the better it is in terms of a tool, and the easier it is for you to then refer to notes about the property. You might have your refurb costs in there, but you might just want to put a few notes in there. The street wasn't the best. Just you can put things in there that you think good rental area for HMO, or might be an Article 4 area, whatever it might be, just something that's important and relevant to the property. Now you'll see here we've got a bridge and loan calculator, so it pretty much pulls the figures through from the above and then calculates them. So again, with bridge and loans, you may have to pay the bridge and loans lenders fees here, which obviously adds value to it, adds expense to it. Sorry, valuation fees, some 299, something like that, depending on the loan. Legal fees, got £1,000. So again, we're just filling the grey columns in. You've got your bridge and setup fees, you've got your interest rates and monthly payments. Probably keeping around that at the minute. You've got your exit fees, whatever they may be. Sometimes they're a percentage of the balance, or sometimes they're a flat fee. So, it just depends what they are. And then any additional costs. So, again, gives you total acquisition costs, monthly rent, new market value, new mortgage valuation fee, because obviously you're going to have to get a remortgage. You might get another valuation fee, and you're going to have to pay your solicitors again to run that one through as well. So typically the remortgages are a lot cheaper than the initial. So we then go monthly cash flow. Months before money's left in the deal, 31, gross yield 12%, 8%, 16%. So it shows you everything that you do on the bridging analysis and get that through. Now, this is lease option, so I'm going to come on to this. It does sit at the bottom of this calculator, but just trying to keep it in order of here. What we'll now do is we'll move on to serviced accommodation and kind of how I analyze that, because this can kind of all flow nicely. So what I will do is I'll just put a test street in here, so you can kind of see how all this filters through. And what you then do is we go on the SA analysis page, and you can see all that data is starting to populate through on this page in this section here. And this refers to, so each column is basically a property, and it all starts from the BRR analysis page. So if we're going to run SA, let's say we have to put some furniture in it. If you're going to be paying a deposit, a rent to SA deal only, or a refurbishment rent to SA deal only, obviously if we were buying this, then our cost is in there to refurbish the property. Whereas if this was a rent to SA deal, then we'd only put the cost in here, and obviously if there's any other costs in there. Advertising and marketing, service accommodation. So you're typically going to rent on the OTAs, the online travel agents, and that's where you're going to market. Now you see here there's a rent and a mortgage payment box. Now the mortgage payment box pulls from the BRR analysis if you complete that, if it is going to be a BRR. If it's going to be a rental deal, obviously that would stay at 0 because you wouldn't necessarily fill all this information in. You just fill the top information in, and then your mortgage pay, you'd have 0 in your mortgage payment, and then you might put your rent in there, or whatever it might be of what you were going to pay for the property. Your rates, so let's just say 110, council tax, light, power, heat, let's say 50 quid, water rates 25, repairs and maintenance. Typically your guests are going to be paying the repairs and maintenance, but you might put a slush fund in there of maybe 30 or 50 quid a month. You'll see here cleaning and linen. Now that has a cost that's going to be accounted for because this is serviced accommodation, but we don't need to fill that in because it's going to auto-populate later on. Insurances can be a bit higher or are a bit higher for serviced accommodation. And then it depends what costs you count into the individual properties. I know when I first started, I used to sort of put all these costs into each property, but as we've grown bigger and we've got guest handlers that deal with everything, it gets a bit harder. So I kind of just leave them out now. I don't put TV licenses anymore. I just put the internet in with smart TVs, consumables, probably 17 quid a month, something like that. If you've got any investors in there, you might, be doing JVs, you might have to pay them. And obviously, if you've got any furniture loan repayments, you might put them in there as costs. So you'll see here, OTA commissions. Obviously, the OTAs do take commissions from you. Now, they all work differently. So this is worked out at 15%. But as you'll see up here, it's divided by 2, so it takes it down to 7.5%. Why I do that is because Booking.com charge 15%, Airbnb charge 3%, direct bookings charge you nothing. So it is just trying to get a happy medium between it all. You don't really need to worry about that too much. You've got your monthly payment and your VAT on your bookings, obviously, once you hit your VAT threshold. Then what we do is we do our weekday nights booked and weekend nightly price analysis. So, we'd be jumping onto sites like Airbnb, Booking.com, Google Maps, and sort of figuring out how much it's going to, what the average rate's more than likely going to be. So I work on 13 weekday nights booked. Again, depending on areas, sometimes you might have, we've got properties in certain areas where they're busier through the weeks and not on the weekends. So, whereas if in Newcastle, for example, I'd probably have it booked on 8 weekend nights booked and 13 through the week. Weekday prices tends to be lower, so let's go £65 for, say, let's assume this is a 2-bed sort of flat. It's at a 50 grand purchase price. Weekends we might get, say, 110. So total number of bookings per month. Once we put the minimum stay, that'll fill in. So if we go 3 nights minimum stay, as you see there, it's going to give us 6 bookings throughout the month, or probably more like 2 nights minimum stay across the portfolio. Cleaning fee, again, you're just kind of putting your costs in here, and everyone's clean fee as well. You'll see there's some guidelines there for what it should be depending on the amount of people. Now, what you'll now see is the so we've got 2 nights, so our linen hire cost has jumped into there, 4 minimus in there. So linen hire, and we've got our cleaning fee there. So we then come down here, and I'm just thinking that doesn't look right. There we go, that looks better. So we come down here, we've got calculate our gross revenue, OTA commission, running costs, VAT, and it shows our total profit, operating profit. What it then has here, I've set this up so there's a seasonal analysis in here. So you can see this is the occupancy rate and the rate increase or decrease depending on the time period. You'll see here in sort of July and August, we have a higher rate than 100% because these are peak times for us. Whereas, in the January months, we might be a bit less depending on what location you're in. You might have your rates set slightly higher for sort of December months. So it gives you kind of seasonal analysis of how your trading income is going to fluctuate throughout that season. And then this shows me here that it's going to take me 5 months to get my furniture costs paid back, based on obviously the average profit of here. And ultimately this property is going to make me £2,000 in the first year, 2.5 by the time the property, and then it's going to sort of step up thereafter and, you know, be quite a profitable venture. A property that's worth 50 grand and going to pull in sort of 495, £300 a month rent is not going to be as lucrative as that. So that's where we would then make the decision that maybe SA is the way forward for that property. So that's how we kind of then filter it into the SA analysis side of things. And as you can see there, you know, if you didn't have a platform like this to kind of quickly punch your numbers in, it's going to take you a lot of time to analyze deals. And also I'm quite confident that this is fully set. So I know that the figures, I can go out there and negotiate with confidence because I know that the figures and the formulas that sit behind this whole thing are set up correctly, that's been tested. We've sort of got rid of all the bugs, and you know, we've negotiated deals, and the deals have come out pretty much how the figures have been on this platform. So so that's the SA analysis side of things. Now if we jump into HMO analysis now, you'll see, I'll just make this a bit bigger. So again, we've got the same property here. So let's just assume that we'll go through a rental strategy on this. So for the sake of this, I'm just going to zero that out and assume that we're going to rent this. We've still got all the information at the top here. We're going to have to buy £2.5 grand's worth of furniture. I very rarely put deposits into my rent-to-rent deals the way we source them, so I'm going to put that 0. But if you did have to pay a deposit, you put it in there, because ultimately it is a cost, especially if you're going to take on like 3-5 year agreement. Effectively, you're not going to see that money for a very long time, so you might as well write it off. Refurbishment, rent-to-rent deal only. So let's say, I don't know, maybe we're going to paint the property and do a few bits and bobs with it. So our total investment cost is 400. Advertising and marketing, you would want to probably get yourself a spare room account set up. So you might set up £99. Let's assume on this your rent was going to be 1,300 quid. And we then go through here, rates, 120 quid. Obviously, light, power, heating, the HMO is going to be a bit more than a service accommodation unit. I like to factor in £10 per person for maintenance. So let's assume this is a 6 bed, 60 quid. Cleaning, we'll do a bi-weekly cleaning there. You wouldn't have a virtual assistant. Insurance, fairly similar to SA, a bit more specialised. TV license, you probably would put one in. So they've got 15 quid, aren't they? Telephone, internet, you obviously need that in, and that will do. So that's your running cost per month for your HMO. And then what you do is your room by room analysis. So let's just assume we've got fairly straightforward 500 quid rooms, all the same. And you know, ultimately your gross revenue is going to be £3,000. And then what I like to do here is obviously you've got your running costs, and then I have an occupancy offset. So for me, it's 83%, which typically is one room less out of the full house, unoccupied at all times. So based on that, 2490 minus your 1873 is going to give me a profit of 617 per month. Now, if I get the 6th room rented, great, that's classed as a bonus for me. And if I get it rented for a long period of time, I'm obviously going to make more than this per month. But as you can see there, if I do have all rooms full, I'm going to be making north of £1,000 a month. I paid £4,000 to set the place up. Within 6 months, it's going to pay me back. Now, why these go green and red, I have a 6-month rule for rental deals. So I want all of my costs back out within 6 months. You know, especially if you're on shorter contracts of 3 years or 5 years, you want money out as quick as possible so you can start making profit from it. So I factor that into this, which is why if these start going red down here, we don't invest, or we need to tweak the rent to make it work, or maybe we might start negotiating some rent-free periods to try and make those figures work. Again, it does your annualized profit, so £3,000, £7,000, £7,000, you know, and it shows you the viability of doing the deal. Obviously, on paper, that's a very good deal, wherever it might be. Hopefully, you're about to start finding these deals because they do exist, and you can hopefully start to see the power of the rental strategy there playing out in front of your eyes. So, in terms of single lets, let's just jump back here. So single let analysis is pretty much here. So we've got that here, your 495s, your 374s, then obviously your refinanced amounts, and then it basically brings it into this spreadsheet here, which just basically compares it like for like. So first year single let profit is going to be that, and but second year single let profit is not going to be that. I'm not sure why that's calculating. Is that cumulative? No. I'm not sure why that. There's obviously a little bug in there. I have to say I've cursed myself by saying there's no bugs in this. Yeah, SA profit in terms of the years, and then and then you've got your HMO profit in terms of the years. So as you can see, if you were toying between, because quite often 4 and 5 and 6 bed sort of HMOs or SAs, you can go one way or another with the strategy, depending on the location, obviously. But as you can see there, if you were deciding between the two, well, the HMO wins all day long, because that's going to make you an extra 10 grand over 5 years. So this is why I kind of have this comparables in here, so I can kind of see which ones. Now, for me, your single lets, they're never going to be as profitable as they're never going to be as profitable as a HMO or an SA. You could get it. You could, if you got a real good deal on a single let, I guess you could argue that you might get it a bit more, especially if it's on a lower bedroom size, of maybe a 1 or 2 bedder, and you've got a cracking deal and you can get some for 500-600 quid a month margin on it somehow. Then you could argue that it might be better than an SA. But for me, these are the super rent strategies. I always try and super rent every property before as my exit strategy. If I can't, it needs to be a single let. As long as it works and cash flows, then we'll do it as a single let. I'm absolutely comfortable with that. But ultimately, I do try and get them onto this platform first and foremost. So that is that's basically how I use a calculator and how I analyze deals. And as you can see, there's quite a bit of information in there, and it allows you to push through. So we then have obviously the lease options. So with lease options, they are a bit more quirky. We discussed these in week 1. So let's assume the current market value of this house, as we know, is 70,000. And let's assume that the profit, the growth on, let's say it's 2% per year, that the property market's going to grow in that area. And we've agreed a 5-year lease agreement. But the predicted market end value of that property with compounding interest is going to be about £77,500. So you might agree a £75,000 sale, and you're not going to be a million miles away. It means that you'll be able to get a mortgage on that. It means that it'll stack up. You might agree the £70,000 that it's advertised for now, depending on the situation. It does just totally depend. Your legal fees and your refurb costs, obviously they all pull in from your BR analysis at the top. And then, you might pay a consideration fee. So you might say, listen, I'll give you £5,000 consideration fee. If you're going to run it on SA, you might have some furniture costs in there. However, quite a lot of lease options you can just run on single lets, and that's why they're so powerful, because it allows you to just penetrate that single let market without having to pay huge rents, because typically we're just taking over the mortgages. Your monthly rent, I think we end up above 500 quid, again, letting agencies, fees, insurance. So your profit's going to be £491. So it's going to take you 23 months to recoup your setup fees. Your setup costs are here, and obviously that's this. Obviously, you can see here there's a refurb involved in this. So you might say I'm only going to give you £1,000 consideration fee, because I'm going to spend £5 grand on your property. Although I guess the way you structure lease deals is that effectively yours from day one, and you're going to buy it eventually. So they'll probably say, well, I'm not really bothered about the refurb cost. That's up to you. But deal by deal, you just go through it. 14 months, and then what this does is this calculates the rolling profit. So over the time period, so we had a 5-year deal here. So by year 5, done correctly, this is going to sort of build up a pot of about £22,000, and that does include your setup costs. So £22,000. Now, what you'll remember from up here is, most of the, as you see here, the total investment cost initially to buy this was £21,000. So, this could be a good lease option. If you're clever about it, what you can do is you can put this money away, and then ultimately when you get to year 5, you're going to have the pot of money built up to be able to then buy that asset, and then obviously it's yours. You know, so that's one thing that, you know, is good about lease options. If they're structured properly, you can actually save the money up to actually then purchase the property. However, if you are on your property journey and you're doing this properly, you would hope that in 5 years' time, you've just got enough money in the bank to be able to pay that, and you can use the cash flow out the lease option to buy more and more over the 5 years. And then obviously you've got your end of term purchase details. So depending on what the deposit requirements are from the lenders at the time, obviously this has fluctuates anywhere from 5% to probably 30-35% over the last 10-15 years. You know, your legal fees, your mortgage broker fee, and any other costs. So your title deeds acquisition cost would be, you know, your 17 grand, you've saved up a pot of 22. Happy days, you know, you can afford that deal in the 5 year time. So that's how I calculate lease options, and that's how basically my whole calculator works. Hopefully you can see that there's quite a lot of time and effort has gone into this. I am a bit of a tech geek. I do know how to kind of write Google formula and Excel formulas to make all these figures kind of populate and compound, etc., etc. But that saves me so much time, and not only that, it doubles up as a sort of data collection tool. You know, we've got spreadsheets with just columns and columns and columns worth of data, and every couple of weeks we go back to these and just keep asking, you know, is this available? Is this available? And you know, it's a hugely powerful strategy, and it works really, really well for us. So so that's pretty much it for the deal analysis stage. Obviously, if you do want a copy of my deal analyze, if you want your own copy of that, there is a link below in the academy to download your own copy. Head over and get yours today. It's, as I said, the amount of time that calculator saved me is unbelievable, and hopefully you can see the benefit in it from what I've just run through there. But whatever way you want to analyze your deals, it's just vitally important that you get your numbers right, that you're using the right numbers, that you're analyzing the right numbers, and more importantly, you don't miss a number out. If you miss a £5 grand refurb out, or you miss a you know, a £2 grand redemption fee on a mortgage, or a £3 grand exit fee on a bridge and loan, they can quickly turn, especially cheaper deals, 50-60 granders, they can quickly turn good deals into really bad deals, you know. So you've got to make sure that you're investing in the right areas, and that your numbers are absolutely spot on. So as always, any questions, head over to the Facebook group. You know, great. I'm absolutely thrilled with the way that's going, and the momentum that's getting, and the way that people are linking up and networking with people. And you say it all the time, you know, property is a people's game, so it's fantastic to see that. And you know, this does take us closer towards the end of the program. We've got a couple of days left. Hopefully your knowledge is so much better than where you were probably 2 weeks ago, and hopefully you're getting a bit of momentum with some of the action you're starting to take, and hopefully you're starting to see, you know, hopefully you get excited about your journey ahead. You know, you're not far away from really, hopefully, opening your property business and giving it a good go, and starting to, you know, change that future for yourself, which is probably ultimately why you came on this program in the first place. So that's it for today. I'll catch you up tomorrow.